Hello and welcome to this week's edition of Taxes in Retirement Live. I'd like to start by saying that here in central New Jersey we are having some bout of nasty storms and weather come through. So if for some reason my internet or power gets cut out, the live feed will presumably end and may or may not be back on. I mean, I guess I can come on with my phone after the fact, but seems like the storm has passed for now. But we'll see. So if we get cut out, it's me, not you. Just wanted to let you know. Quick few dad jokes for tonight, and again, today's topic will be discussing asset location. Everyone knows about asset allocation. Tonight will be asset location, which I'll touch on in a bit. So let me kick off with these jokes. So first, why are walruses never offended? Because they're thick-skinned. Next, did you hear about the guy who invented Altoids? They say he made a mint. He, literally and figuratively. Good for him. And finally, yesterday, your mom and I watched 3 movies back to back. Luckily, I was the one facing the TV. Back to back, right? Get it? Okay, good. Done. Okay, so let's move on. As always, feel free to post comments, questions. There is, again, 50 to 20 second lag, I think, so I may not see them immediately. I see there is one comment. Hi, Shauna. So, yes, comments are clearly working tonight, thankfully. I just want to say congrats to all the tax preparers out there. As everyone knows, the normal tax season ends April 15th. This year was July 15th. It was extended because of all the economic issues with the pandemic. I myself do some tax prep, but I intentionally keep it small to fairly straightforward returns, and then returns of clients from my financial planning and investment management business. But again, I want to keep it small, so I thankfully wasn't that beat up with things. But I know people were working all the way through up until the end of last Wednesday, July 15th. So thankfully for all the fellow tax preparers out there, I'm glad things are done. You get a little bit of a break now, but now the extension season fires up because extensions are due October. So, right. So tonight's topic, asset allocation at a high level, as everyone knows, that's the mix of you have your whole portfolio. How much of it is stocks versus bonds versus cash versus real estate versus whatever. It's as the name implies, it's how your assets are allocated across your whole portfolio. Asset allocation is extremely important. Getting your asset allocation wrong can really potentially tank your future investment returns and therefore your long-term financial plans. At one extreme, if 100% of everything you own is all in one stock and that stock ends up being a fraud or something and goes to zero, well, guess what? You lost everything. That's clearly not diversified at all. That's not allocated. I mean, it is allocated. It's allocated 100% to one stock, but that's the wrong allocation. The other extreme would be like if every single thing you owned was purely in cash, sitting in your mattress, for example, or even at a bank earning nothing in a regular checking or savings account. Yeah, you're not going to lose anything, but you're not going to make anything. And not only will you not make anything, but your cash won't keep up with inflation over time. So you're actually, in effect, losing money by just keeping it in cash. So that's a bad allocation as well. The typical allocation is like 60% stocks, 40% bonds. That's often referred to as like the Swiss Army knife of, I credit Benjamin Brandt for that one. That's where I got that term. The Swiss Army knife of allocations, because it kind of does everything fairly well. Whatever you need, it's got some growth, it's got some income, it's got some protection, has some dividends, what have you. So anyway, that's an allocation, like 60% stock, 40% bonds. And getting that right is very important because, again, if you get it wrong, you can really derail your future by having a bad allocation. So what we're talking about is asset location, which most people probably don't think about. I'm sure you know it exists. After we discuss it, you'd be like, oh yeah, kind of knew that, but you may not have actually thought about it as its own thing. So location is simply, well, not simply, but like the name implies, it's where your assets are actually located. Allocation's one thing, but what types of accounts you put them in is the other thing. It's driven by the fact that certain types of assets, due to the way they're taxed, how their income or their gains are treated or whatever, depending how those are taxed, those assets are best suited in certain types of accounts. And there's really 3 types of accounts. There's a regular or taxable brokerage account, it's called. That's something you fund with after-tax money. Things in there could be interest, could be dividends, could be capital gains or losses. Those things all may or may not be taxed depending on the rest of your picture. For example, losses aren't taxed. In fact, they actually help reduce other sources of income you have up to a few $1,000s a year. Gains may be taxed. A stock goes up in value and you eventually sell it. If you sell it within a year of holding it, it'll be taxed as regular income. That's not ideal. If you sell it after holding it more than a year, it'll be taxed at what's called capital gains rate, which is going to be lower than your normal income tax rate. It's either 0, 15, or 20% capital gains rates. And even then, it won't necessarily be taxed. So let's say you did sell something that was at a gain, and you have something else that was currently at a loss that you wanted to sell and get rid of anyway. Well, you can sell that at a loss. That loss can offset your gain, and just like that, you kind of sort of flatten yourself out tax-wise. So that's a regular taxable brokerage account. That's first type. Second type is Roth. I think everyone knows about. I harp on those pretty firmly within this group. So Roth is money goes in after tax, and then everything in there should then be tax-free from that point forward. Stuff grows without tax. All your distributions, assuming you meet the qualifications that we discussed a few weeks back, all of your distributions will eventually be tax-free as well. So that's the second type. We'll call those either never taxed or tax-exempt accounts, or just simply Roth accounts. They're one and the same label. And then the third type is tax-deferred. That's your traditional IRA, your traditional 401k, 403b, 457, TSP, etc. You get a tax break when you put the money in, a tax deduction when you put the money in, and then everything that comes out, whether you take it out the next day or 40 years later, everything that comes out is subject to regular ordinary income tax. It doesn't matter if it's ultimately a dividend that you're taking out, or an interest payment, or a capital gain on something. Doesn't matter. It's simply every dollar that comes out is taxed, plus potentially a penalty if you take it out too early. But we're not talking about the penalties. We're just talking about the sort of taxation here. So that's what I mean by location. Depending in which one of those three account types you put your assets, that's its location. And certain assets are better suited to be in specific of those three different accounts. Now, of all the topics we've discussed so far throughout these weeks, and of the topics we'll discuss going forward, this one, frankly, is one of the more kind of subjective ones, if you will. A few of the things we're going to discuss are pretty black and white. You want to try to do or try to avoid, but the rest of it, it's really open to debate, honestly. So a lot of my comments here heavily influenced by kind of my perception and my views towards things. Other people can make very defensible arguments, and this is open to debate. I'm not saying I'm right or wrong, or anyone else is necessarily right or wrong. There's a lot of what ifs and assumptions that kind of go into this. There's some things that generally should work out better than others, but again, a lot of this can be debated. And academics love to write papers about this, really detailing out to the nitty-gritty penny. Well, if this happens, then you're better by doing this, and if this happens, you're better by doing that. No one knows what's really going to happen. We just have some sort of educated guesses. So that's what my comments and my sort of ideal asset locations are based on, is what we know now with tax law and the way assets work, and what we expect to be the case going forward. So again, don't pin me down and say this is absolute fact that this has to be here or this has to be there, etc., because it's not quite like that. And again, keep in mind, asset allocation, if you get that wrong, that can really mess you up, right? And your finances and your investment returns. Getting this wrong, getting your location wrong, won't completely snarl or derail your future. It's not like getting asset allocation wrong. Getting location wrong, not ideal, but it's not going to crush you, to be honest. But getting it right can definitely make things better, albeit just incrementally sometimes, but it could make things improve your after-tax return over the long term. So getting location right is good. Getting it bad, not the end of the world. So don't lose sleep over it. And like I said, it's pretty subjective. And I even debated myself in coming up with this list of like, well, is this good? Is this bad? Or is this indifferent? I was like, I changed my mind and waffled a little bit on a few of these things. I did look up additional resources online and get slightly different answers. So that kind of confirms my views that this isn't an exact science some things are more compelling than others, but go Expos. Thanks, Aaron. Yeah. I was in Montreal a handful of years ago and saw this shirt and liked it. And I know the Expos, the baseball team, hasn't existed for quite a while, but they still sell these shirts as if the team's still around in Montreal. I guess this is one of the the big things come out of Montreal, at least as far as Americans are concerned. So look at me, I'm a sucker who bought one of the T-shirts, a decade after the fact, after the team went away. Right. So I just want to preface that about asset location. This is almost more art than it is science. A lot of financial planning is really technical, really formulaic, etc. This is somewhat technical and formulaic, but a lot of it's just kind of I can be swayed in multiple directions depending how compelling of an argument or a case someone's trying to make to me. So the main themes with this to keep in mind, the overarching premise behind this is that things that generate or throw off ordinary income, things that are taxed at your regular income tax rates, the same as your wages or whatever, those should ideally be in some sort of tax-free account like a Roth or a tax-deferred account. If you have them in a regular taxable brokerage account, you're going to pay regular income tax on it in the year those income flows happen. You can't control it, they just kind of happen, you can't defer it, etc. So that's one theme. The flip side of that theme is, to the extent there's something that generates income that is otherwise tax-free, you don't want to put that in a tax-deferred account, like a municipal bond, which we'll touch on. But for the most part, at the federal level, interest payments from municipal bonds are tax-free. So you generally want to hold them in a regular taxable brokerage account because they're not going to be taxed. So just let it flow through to you without tax. Everything's great. At the state level, it's slightly different. I won't be touching on state taxes here. Again, every state, I mentioned this before, there's 50 states. They all have different twists and turns to their tax laws. So I'm just discussing federal taxes. And for the most part, you shouldn't usually let state tax considerations drive the decision when you're doing any sort of tax planning, because the federal levels are just significantly bigger. It's potentially dozens of percent, whereas in most cases state taxes are single-digit percent, maybe low double-digit percent. So don't even if state tax does come into play for you, that should in most times be the secondary consideration, taking a backseat to federal income tax purposes. So things that are tax-free, like federally tax-free, like interest from municipal bonds, put them in a regular brokerage account because you won't be paying tax on it. Do not put them in a tax-deferred account because you're now subjecting yourself to have to pay regular ordinary income tax whenever you take money out of that. So you're now putting tax on something that otherwise would not have tax. So that's the flip side. So things that do generate taxable income, you usually don't want in a normal brokerage account. You want to shelter it or defer it in a Roth or a tax-deferred. Things that have interest-free income is the opposite. You do want those in a normal brokerage account. You don't want to subject them to tax through a tax-deferred thing. And now here's another one where the sort of third point to keep in mind, and this is where it's kind of more subjective than not, is things that can appreciate a lot in value. So stock that you buy low and hope it absolutely crushes it and quadruples or goes up 10 times in value. Those are, in my opinion, usually better to have in like a Roth account, something that's tax-free, because all that gain that eventually gets built up, you can take out tax-free. If you have it in a tax-deferred account, yeah, you're deferring and not paying tax along the way. You're deferring a lot of gain, but that means you're deferring a lot of gain, which I don't think is good, right? I'm answering the question by saying the same thing. That just means you're kicking a larger tax can down the road. So things that have the potential to build up a lot of value, usually not good in tax-deferred things. Keep it in like a Roth or even a regular taxable brokerage account, because again, the way that capital gains are treated, capital gains is when you sell something at a gain and you held that something more than 12 months, tax on capital gains is lower than your regular income tax. So even keeping things like hot stocks that may go up a lot in value, keeping them in a regular brokerage account is still better than not, as compared to putting it in a tax-deferred IRA or a Roth, tax-deferred IRA or 401k. Brian Williams, nice play on words. Asset exposure with the EXPO and capitals. Yeah, I mean, this shirt's a big hit. Wow, I didn't realize I was making such a statement tonight. I'm glad you all are finding it entertaining. All right, so I did make a table to summarize this. Now I realize this isn't the best venue to show, a multi-row table. With that said, I am in the works of doing one of my YouTube videos on this, where it's a little more formally hashed out and scripted, and there will be this table, and I may even possibly make this some sort of shareable PDF, like I did with the Roth withdrawal rules a week or two back. So I'm just going to walk through this. Don't get too hung up on it. Feel free to screenshot it if you want, but this will be in more detail in my YouTube video, which I'll share. Give me that'll probably be out maybe tomorrow, not tomorrow, Friday perhaps. All right, before digging into this, looks like there's a couple questions here. Can you do a tax gain harvesting in an IRA account? So that's a question from Michael. Not sure I understand. I don't know if you're intentionally calling it tax gain harvesting as opposed to tax loss. So tax loss harvesting, which is on the schedule to be discussed in a handful of weeks in one of these lives at a super high level, that is if you have a regular taxable brokerage account and you have something that you're selling that's going to generate a taxable gain, you can help offset that gain by selling something else that's going to create a realized loss for you. So something you wanted to sell anyway, its price has dropped, you think it's a dog, whatever, you've just been saving up the day to sell it so you can sell it in the year that you're going to otherwise have a gain. That's called, you're harvesting that loss for tax reasons. That's a tax loss harvest where that loss will help offset your gain. So that's tax loss harvesting. I haven't really heard of tax gain harvesting, but regardless, you're asking if you can do it in an IRA account. I don't think so, because anything IRAs don't generate tax upon gains or upon purchases or sales. The way IRAs are taxed is every time you take anything out, doesn't matter how that money got there, whether it was a contribution, whether it was a gain, whatever. Anytime you take money out, you're paying regular ordinary income tax. So honestly, it doesn't matter what happens inside that IRA. You can have a flurry of activity every single day. None of those buys, sells, whatever, generate any tax impact. The tax is solely upon when you take money out. So Michael, to answer your question, I'm not 100% sure what you're asking, but I don't think it's going to matter anyway, because an IRA, it doesn't matter what you do inside of it so long as the money stays inside of it. It's when you take the money out is when you have a tax bill. And if you sold something that has gone up in your 403B years later, not while taking RMD, will it cause any taxes? No. Exact same structure and response to my comment to Michael about the IRA. So just stepping back, I thought about doing a video on this at some point. When we talk about account types, like an IRA, a 401k, a 403b, those aren't investments in and of themselves. They're just simply, it's a tax classification that you can use for your account. Let me think about that another way. It's basically a bucket. It's a bucket that has certain tax characteristics. In the case of an IRA, 403b, 401k that are all traditional tax deferred, the characteristics of that tax bucket are that anything that comes into it does not have tax paid on it. You get to deduct it at the time. Whatever's in the bucket, it doesn't matter what happens while it's in there. Whatever you buy, whatever you sell, whether you buy or sell at gains or losses, it doesn't matter. It all sits in that bucket and just hangs out, because that's the way it's structured from a tax perspective. Only when money comes out of that bucket, that money's taxed. Whether it's a penny, a dollar, $1,000, or $1 million, that's all taxed as ordinary income in the year it comes out. It doesn't matter if that income that you're pulling out was attributable to something you sold at a gain inside there, or if it was income that was paid from bonds or dividends paid from stocks. Doesn't matter. So Michael, and Anisha, to your question, it doesn't matter. Whatever happens in that bucket, in your case, Anisha, the bucket's the 403b, it is what it is. There's no tax impact or implication along the way while it's in there. Only when you take money out, you then pay tax on that money as regular income when you take it out. Hopefully that answered your question. Yeah, so, okay, Cody, thanks. You responded back to Michael. Right. So, okay, so Cody and then Anisha, you're saying tax gain harvesting is going up basis on the same funds. There was a question in the, not to get too off track from asset location, but since a few people are talking about this tax gain harvesting idea, there was a post question in the group a few weeks ago about someone had a loss from a security that they sold, and or there's a lot of loss in that security, more than the $3,000 that the federal government will let you eat against or apply against ordinary income. So let's just assume it's $50,000 of loss. I'm making that up. If there's no gains to offset it in the year you have those losses, you can only deduct at most $3,000 against your other sources of income on your federal tax return. So the question was, if there's something that's at a gain, can I sell it, realize some of that gain to help, soak up some of that loss, if you will, and then immediately rebuy that same position that I just sold at a gain and just basically reset my basis. So basis means if you bought that stock at $10, it's up now to $100, so you have a lot of gain. You want to sell some of it, realize that gain to eat up and offset some of that loss you have on something else, and then rebuy those shares at $100 per share or whatever I said. That would be tax loss harvesting. And my response was, and I think this is the right way to view it, is no, you shouldn't do that, because the question was, well, I have a whole bunch of losses here that I can only dribble out $3,000 per year to offset my other income. And I'm like, yeah, that's good. What you're doing is, the gains that you are realizing solely for the purpose of trying to offset your losses, those would otherwise be taxed at the favorable capital gains tax rates, 0, 15, or 20%. That's if you just sell those outright. If you're now selling those to offset some gain, to offset some loss, you're giving up the ability to use those losses to offset regular ordinary income to the tune of only $3,000 per year. But the gist is, no, don't tax loss harvest, because you end up making yourself worse off from a tax perspective. I'll leave it at that. I just feel like I got a little too technical and convoluted in this explanation. This is something that's better seen through formulas and figures. But anyway, tax loss harvesting, I guess, is a thing, but to me it doesn't make sense unless there's some other angle that you all are thinking of that I'm not considering. But typically, no, don't do that. All right, cool, good. So back to this chart now. Again, don't get too hung up on it. You'll find this in my other video and more readily available. But the gist here is, these are all the major asset types. Now, this list isn't conclusive. I don't have traditional real estate. I don't have commodities. I don't have alternatives. It's just the most common stuff: stocks, bonds, and then I threw in Reits, real estate investment trusts. Sort of trade like equities, but they're slightly different, and I'll touch on that. So here's all your basic asset types, and here's the 3 account types: regular brokerage, Roth account, whether it's Roth IRA, Roth 401k, it doesn't matter. They're all the same tax bucket, same tax structure. And then tax-deferred, that's the bucket that would be IRAs, 403bs, 401ks, whatever. Oh, let me get this up here. And then here's my little legend here. Again, there's not necessarily bad ways to asset locate. There's ways that are better than others, and there's things you should try to avoid, but don't get too hung up. Like, the X means try to avoid it. It doesn't mean, oh my God, if you do it, you're going to completely destroy your financial future. No, right? Avoid it so you can make yourself better off, not avoid it because it's going to crush you if you don't. 1 check just means, yeah, good enough, fine. And 2 checks is like, yes, that's ideal. And again, there's some subjectivity layered in here, so don't take this as gospel. So starting with bonds, corporate bonds like those issued by the U.S. Treasury, or government bonds or corporate bonds, where should they ideally be held? Let's pay attention to where they shouldn't be held. So there's really only 3 things, and these 3 highlighted things here. Those are the things you want to avoid. Again, they're not going to destroy you if you don't, but if you could, try to avoid these. Everything else, whatever you're going to do is more or less fine. There's slightly better ways to do things possibly, but these 3 are the ones you really want to keep in mind and try to avoid. So if you have regular U.S. Treasury bonds or corporate bonds, you ideally do not want to hold them in a normal brokerage account. That's because the majority of the return from bonds like these, let me do this so I don't have to stand up like a fool the whole time. The majority of the return from bonds like that are going to come from interest. You're not going to buy one of those bonds at $5 and it's going to go up to $100. It's possible, but it's exceptionally rare for the most part, the majority of your return is coming from interest. Interest is going to be taxable as ordinary income. So you, if you can avoid it, don't have that ordinary income flowing into a regular brokerage account where you're going to be taxed in the year it happens. You're not going to have control over when you pay the tax on it. Ideally, try to punt it to like a tax-deferred account. Still fully taxable again whenever any money's come out of here, but you're deferring the income, you're deferring the tax on that income to some later point when you have a little more discretion over when you choose to take money out of that IRA. That's when you're going to pay tax on it, not in the year it's paid, as would be the case if it's in a regular brokerage account. And then Roth. So this is the ideal location for regular corporate and government bonds. Why am I saying Roth is just good enough? This is one I debated about. You're no worse off by having bonds in a Roth, but my view is save the Roth for stuff where it would be better, which is basically equities, and you'll see that here. If all you have is a Roth, fine, go ahead, put everything in it, good for you. But if, like most people, most of your money is probably in tax deferred, or you have some Roth as well, some regular brokerage. To the extent you can rejigger and shuffle stuff, I would usually lean towards saying taxable bonds should be here, Roth if you want to, but this is ideal. Roth isn't going to hurt you. It's good enough if you had to. Save your Roth allocations for other stuff if you're really limited on how much you can move around. The other thing to consider is if you already have your money and your securities in certain types of accounts, don't go and automatically rebalance everything across all these accounts tomorrow, because you can have some really nasty tax impacts. Going back to this bucket concept, anything you do within a tax-deferred bucket like an IRA, there's no tax implications at the time you do it. Separately, you have a Roth bucket, Roth tax characteristics. Anything you do inside your Roth isn't going to generate any immediate tax implications. So you can buy, sell all you want. Keep in mind trading commissions, whatever, but from a tax perspective, doesn't matter. Once you cross over, if you say, oh, junk, I have a taxable bond in my Roth, Andy says it'd be better in tax deferred, let me go move that bond from Roth to tax deferred, or vice versa. Don't do that. Unless you really carefully consider the tax implications and work with a planner or an accounting specialist, because you can trigger off some really nasty tax surprises by doing this. Like if you convert money or take money out of a tax deferred account, move it to a Roth, that's taxable when you do it. So don't just go hog wild moving all your stuff after this video. Avoid that, right? This is more for going forward when you're keeping in mind, you're putting money in here and there. Where should it go? What should be invested in? Keep it in mind there. Don't after the fact go and move all your accounts all over, because that's not going to end well for you. All right, so that's regular taxable bonds, U.S. Treasury bonds and corporate bonds. Municipal bonds are very different. As I touched on before, municipal bonds, for the most part, the interest paid on those is tax-free at the federal level. So because it's tax-free, the ideal spot is to hold those in a regular taxable brokerage account, because you won't be paying tax on that income. Definitely do not intentionally put municipal bonds into a tax-deferred account, because like I said before, you're now taking interest that otherwise would not be subject to taxes, and you're all of a sudden now making it taxable when you pull that money out. That's a big no-no. Can you hold municipal bonds in a Roth? Yeah, sure. Like the other bonds, I can't think of a scenario where it makes you worse off than if you held them in a regular brokerage account. But like before, if you can, save your Roth investments for the stuff where it matters more, which is equities. And I should also mention that I'm only addressing actual security types, stocks, bonds, whatever. These classifications apply just the same for mutual funds or exchange traded funds. So whether you own municipal bonds individually, you have a portfolio of 12 individual municipal bonds, or you own one single mutual fund or ETF that owns a bunch of muni funds, this stuff all applies just the same. So you can consider these mutual funds or exchange traded funds if you want to, or individual securities. It still works out the same at the end. And I realize I keep holding this thing crooked, sorry. All right, moving on to equities. Let me get a drink of water here. Okay. So now within equities, I sort of broke this up in three ways, and you can even delineate this more. Like I said, this whole thing, the more you think about it, the more you try to come up with like the exact precise right answer, the more you're going to make yourself crazy, realizing you're just spinning your wheels. So here's some kind of high level food for thought. So within equities, there's stuff that's what I call low turnover. Those are stocks that you buy and hold for a while, specifically more than a year, because then that's a long-term capital gain. Or if it's a mutual fund or an ETF, this would be ones that are passively managed, those that basically just buy and hold a whole bucket of securities because they're tracking an index or something. It would not be the actively managed mutual funds where the fund manager is, intentionally buying and selling stocks every handful of days or weeks or whatever to try to pick the winners and sell the losers. No, this is passive stuff where the stocks are just bought and hold for, ideally, typically a year or longer. So where would you hold them? One good spot is a regular taxable brokerage account. That's because, again, long-term capital gains, so anything that's held more than a year, is taxed at the favorable capital gains rates, which are 0, 15, or 20%. And that depends on the rest of your income. So just looking at single folks, for example, if you have only up to $40,000 of taxable, other forms of taxable income, capital gains will be at 0%. So you could, in theory, have a stock that you made money on because you bought low and selling high. You can have that taxed at 0% even in a regular taxable brokerage account. For married people, that's you can have taxable income up to 80 grand. In that case, your capital gains would be 0%. Above that, most capital gains are going to be 15%, and then eventually, when you get over like $400,000+ of income, then your capital gains start getting taxed at 20%. Which isn't low, but it's still better than the, potentially 37% ordinary income that you would otherwise pay. So that's why stocks that you hold for a long term, meaning low turnover, you ideally hold it more than a year, it's good to hold those in a regular taxable brokerage account. Same thing with Roth. So, and why is it good in a Roth? Well, again, because Roth, and basically you can see everything kind of works in a Roth by my opinions. There's no tax ever unless you don't meet the qualifications, the withdrawal qualifications, but assume there's no tax on Roth withdrawal, so all that gain is going to be tax-free. And because equities, more so than bonds, equities are more likely to potentially build up large gains, multiply in value multiple times over potentially. That's a lot of gain that you can accrue yourself over time. It'd be great if you can have that gain all build up somewhere tax-free that whenever you take it out, you eventually pay no tax on it. Whereas if you have all that gain build up in a tax-deferred account, like a regular IRA, you will have to pay tax on it. The upside of tax deferral is you don't have to pay tax along the way, but the downside is you're just kicking the tax can down the road. So the more gain you build up, that just means more taxable income you're eventually going to have, which is why I'm only giving this one check to hold any form of equities inside a tax-deferred account. Yes, you're delaying taxes, but you're not getting rid of them. You're just making your future self have to worry about it. All right, stop after that one. A couple questions here. David, what would be the ideal percentages for holding taxable, tax-deferred, and tax-free? Fantastic question, to which there's not a great answer. This is what makes my job and this tax planning thing so difficult, is there's so many unknowns about the future. If we knew with certainty what tax rates would be and when, and we also knew with certainty what your taxable income will be, it'd be very easy to figure this out. It'd be simply, what are taxes today, what are taxes in the future, let's pay wherever it's cheapest. Well, we don't know what's going to be cheapest. There's one really big unknown, which is tax legislation. We have no idea what taxes will be in 10 years, 20 years, 30 years, 40 years, depending how old you are, how long you're going to live. We know taxes are going higher in 2026, if not sooner, when the Tax Cuts and Jobs Act expire and tax rates are all going up. I think it's 3%-ish, 2 to 4% per tax bracket. Will go up higher than what they are now starting in 2026. That's what we know for a fact. Beyond that, who knows? I have to assume taxes will go up even further down the road to help pay off the trillions of dollars of stimulus that were recently created in the last few months. So to get back to your question of how much in each, Partly personal preference. I think the best you can hope for is to have kind of equal amounts throughout each. That'll give you quote unquote tax diversification. So regardless what the tax legislation is in 10 years, 30 years, whatever, regardless what your other sources of income are at the time, you'll have control over where you pull your money from, where you pull your income from, and how much of it's taxable. So you don't necessarily want to bite the bullet and get every single dollar of your savings into Roth now and pay all the taxes now, because maybe you will be in a lower tax environment in the future, but maybe you won't. So how do you hedge yourself? You just kind of spread your money. Your goal is to spread your money around, have a good chunk in tax deferred when you get to retirement, a good chunk in Roth, a good chunk in regular taxable. That's kind of the best you can hope for. Some people, if you personally feel, super strong that taxes are going up, it's fact, I don't care what you tell me, I know it's going to happen, then fine. Then you're probably more likely than not to convert more into Roth now or put more into Roth now so you get to retirement with only a tiny portion in tax deferred. Other people may feel the other way around. You're like, nope, I don't buy it. Taxes aren't going up nearly as much as you say. Stop talking. If that's your line of thought, so be it. Then you're probably going to have most of your money in tax deferred. Not a great answer, but it's honestly the best answer I think anyone could possibly give to that question, David. Thank you. Kathy, I was putting stocks with lower growth potential in the tax deferred account and those with higher growth potential in the Roth. My reasoning was less growth equals less taxes. Makes sense. Yes, 100% right. Like I mentioned before, the higher growth stuff, if it's me, I'd rather have the stuff that builds up the most value eventually come out tax-free, like in a Roth. The stuff that won't build up as much value, put that in a tax-deferred, like an IRA. So, yep, good line of thought. All right. Let me take one more question here before I move on. What time is it? Okay. So, Michael, I'm not sure if I understand. So, if I have stock in a taxable account that has a large gain and I retire next year, I can sell the stock and have up to $80,000 in gains and not pay taxes on it. No, not quite. I won't get too much into it here, Michael, but that 80,000 figure I gave was that's if you're married and you file a joint return and your other sources of taxable income. So let's just assume wages. We'll keep it simple. You had 80 grand in wages and you have no other income besides this capital gain on your stock. Because your other taxable income is only 80,000 or under, your capital gain, you'll pay regular income tax on your 80 grand of wages, but your capital gain, because your other taxable income was only up to 80 grand, your capital gain will be at zero tax. So in that case, you sell your stock tomorrow, all that gain is tax-free, but you'll still pay regular income tax on your first 80 grand. That make sense? And then just for what it's worth, if so 80 grand is that first trigger level of other taxable income for married couples. Anything up to 80, your capital gains on top of that will be zero tax. And then from 80 to almost $497,000 of other taxable income, all capital gains stacked on top of that are taxed at 15%, and then 20% after that. So I'll leave it at that. Hopefully that answered your question, Michael. If you have additional, you feel free to shoot me an email or message afterward, and I could dig into that further with you if you'd like. Cool. All right, chugging back along here. So let's move on now. So we talked about low turnover equities, meaning those you hold or plan to hold for a long time, 12 months plus. How about high turnover equities? So those are equities you flip, you buy and sell, within days, months, within a year. Basically, the gist is that if you hold it less than a year, whether you hold it a day or 11 months and 25 days, it's less than a year, just the same. Any gains you have on those will be called short-term capital gains. Those are taxed at regular income tax rates, just like wages or whatever else. So for that reason, you usually should not or try to not have short-term gains in a regular taxable brokerage account, because that's all going to be regular ordinary income tax, taxed as regular ordinary income tax. So what do you do with them? Ideally put them in a Roth, especially if they're things that you think can grow a lot in value over time. I guess no, that wouldn't be the case. If you're selling it within a year, then you wouldn't have a lot of time per se, but nonetheless, if you can get that gain into a Roth account where it's ultimately going to come out tax-free, good for you. Next best thing, put it into a tax-deferred account like an IRA or a traditional 401k. You defer the tax. That's the cool part. The bad part is you eventually have to pay the tax at some point. So again, the big takeaway, these 3 yellow things, those are the ones you want to try to avoid. The rest of it, don't lose sleep over it. You don't have to live by this like it's rule written in stone. This is just sort of most likely best case outcomes. If you do keep these types of things in these accounts I'm summarizing here, you'll probably end up slightly better off down the road from a tax efficiency standpoint. These 3 yellow ones, again, definitely try to avoid if you can. Don't go out and swap all your accounts tomorrow, but if you can avoid these, do. The rest of them, it's really food for thought, if more so. Next, equities that have high dividends. Yeah, get that closer to the camera. This one I had to think about for a while. So dividends, and I'm kind of assuming these are stocks you hold for a long term, over a year. So in this, it should also say high dividends and low turnover. Now, I'm sort of implying if you're buying a stock because it's paying a good dividend, you're probably going to hold it for the long term anyway, because you're most likely buying it to get that ongoing stream of dividends every quarter or whatever. So I'm assuming you're going to hold this for the long term, more than a year at least. So where should you hold that? Well, this is good in a regular taxable brokerage account. Again, if you're holding it more than a year, the eventual gain on the share on the sale of the shares will be at the favorable capital gains tax rates. And dividend income, in many cases, especially if it's U.S. stock, the dividends can be what's called qualified. Qualified dividends, those dividends are also taxed at the favorable, the lower capital gain tax rates. Dividends that are not qualified are taxed just like it's bond interest. It's regular, ordinary income in the year you get it. Not to get too off topic, but what makes a dividend qualified? I forget the exact rules, but basically it's a dividend paid by a U.S. company or even a company whose shares are listed in the U.S. like a ADR, but let's assume it's U.S. companies for now. And you hold the stock, I forget the window. It's like you hold it for more than 60 days total, inclusive of the period before when the dividend happens and the period after. You need to have it in like the 60-day window. Assuming you meet those things, and there's a few other smaller criteria, but assuming you meet those things, the dividends you receive will be quote unquote qualified, and qualified dividends are taxed at the lower / favorable capital gains tax rates, which is why I'm saying equities that pay high dividends they'll do you well to be held in a regular brokerage account. Or again, also a Roth for the reasons we discussed before. Everything's eventually tax-free, especially large growth, and even all the dividends eventually are tax-free when you pull it out. And just like the other reasons why equities, I say, yeah, fine, they're good enough to be in a tax-deferred account, so go ahead and put them there if you want, but I feel they're better in a Roth. Okay, there's a question from Pearl. Let me just finish up this last row here, Pearl, and then I will answer your question. So finally, real estate investment trust, aka Reits. These look and feel like equities. It's basically, there's special legislation wrapped around them, but it's in essence an equity that can only hold or needs to hold a certain portion of what it owns. It needs to be real estate or real estate related things. It could be actual office buildings that the company owns and rents out, and that's how it gets income. It could be physical real estate that isn't necessarily rented. They also need to pass out, I forget what it is, it's 80% or something like that. All the income it takes in needs to be paid out in the form of a dividend. The difference with REITs is that the dividends they pay out aren't normal dividends, and they don't get the favorable qualified dividend treatment that regular stocks do when they pay dividends. By default, any dividends you get from a REIT are taxed as ordinary income. Now there's a little bit of saving grace, and basically 20% of the dividend that you get can be tax deductible under the, it's called section 199A within the tax code. It's beyond, the details of that are beyond the scope of this, but the point is Dividends from REITs are taxed as ordinary income, but you can typically deduct 20% of them. So that gives you a little bit of tax break. For that reason, because there's a little bit of tax break, I said, yeah, it may be okay. It's good enough to hold these in a regular brokerage account. And again, because REITs are functionally kind of like equities, to the extent that they go up a lot in value and eventually sell it at a gain, again, the long-term gains are pretty good things to have within a regular brokerage account, which is why I'm saying REITs, yeah, good enough having a regular brokerage account. Again, me being an absolute Roth junkie, I really don't see anything bad being in a Roth, but since these are functionally equities that do pay a dividend that has fairly high taxability to it, it's good to have all this income and gain stuffed inside a Roth where it eventually comes out tax-free. And then finally, tax-deferred, kind of for the other reasons I talked about, could potentially have a lot of long-term gain build up, which is slightly good, slightly bad. And because the dividends that it pays, most of it is subject to regular income tax, it helps that you can kind of defer this and control when you take it out and realize taxes. All right, that's that. Now, I realize this is one of the probably more technical things we talked about, even though it's also one of the most subjective. Go figure. I don't know how I managed to wangle those two things together, but hopefully this was good food for thought. Like I said, don't lose sleep over this. This isn't something you need to go create some fancy spreadsheet or formula and like nail things down to the penny of how I need to relocate stuff. No, it's really going forward. Keep this stuff in mind. Avoid those three things if you can. Again, those three being government and corporate bonds in a brokerage account, high turnover equities in a brokerage account, and municipal bonds in a tax-deferred account like an IRA or 401k. You try to avoid those three things. The rest of it, fine. Don't lose sleep over it. All right. So let me get back. There's some questions here. Pearl, do capital gains count toward the Medicare threshold, about 170,000? Medicare premium threshold, 170,000. Wow, that's a great question. Yes, I need to fact check myself, but the answer is some form of yes. So I'm trying to visualize the income that's used for purposes of those Medicare premiums is adjusted gross income. Adjusted gross income captures your capital gain. Does it capture the portion that's not taxable though? That I don't know. So great question. If you have a long-term gain of $20,000, let's say, so let's assume your regular other sources of taxable income, wages, IRA withdrawals, whatever, is $160,000, and you have $20,000 of long-term gain, and let's just assume none of that's taxable, which isn't the case, but let's just assume, would that $20,000 still be tacked on to the 1/5 to the one? Yeah, would still be tacked on for purposes of this. I don't know. Definitely the taxable portion would. If it's not taxed, even the non-taxable portion may be added. I need to check that. I don't know. Pearl, great question though. Deborah, will I post this video somewhere? Yes. So every one of these videos after the fact is saved on my YouTube channel, which I sent the link to last week, and I can share it again. So Facebook does keep these videos for some period of time. It may only be a handful of days, and they're hard to find. Apparently, they're hard to find while it's happening, from what I'm told. I believe they pop up in the timeline, but some people are struggling to see them. They're definitely hard to find after the fact because they kind of get filtered way down into the timeline. But regardless, I do post them to YouTube, which has a link that's shareable, and I plan on keeping the videos there indefinitely. So all of these videos are currently saved there, as will this one, after we're done here. Layla, so what is a non-qualified dividend? Simply put, a non-qualified dividend is every dividend that's not qualified. So again, to be qualified, I'm forgetting the exact rules, but basically it needs to be from a U.S. company, and you need to have held the stock for, I think it's 60 days, give or take, around the time when that dividend happens, and some other relatively minor criteria, but those are the two big ones, I believe. So let's say it's General Electric, U.S. company. You only owned the stock for 10 days before it paid the dividend, and then you ended up selling it 30 days after. So you only owned it for 40 days. That would not be a qualified dividend in your hands because you did not meet that 60-day window or whatever that time period is. You'd still get the dividend. Let's say it was $1. You'd still get paid $1 per share, but come tax time, that would not be considered qualified. So you would have to pay regular ordinary income tax on that dividend. That's non-qualified. If it was qualified, in your case, if you held it more than 60 days, you still would have got that same dollar. The dollar amount doesn't change. It's the taxation of it that changes. So come tax time, that dividend, because it would have been qualified now, would have been taxed at the lower 0, 15, or 20% tax rate. Good. Okay. Cody, are REITs good enough in the taxable brokerage account because of the QBI deduction on REIT dividend income? Previously, they would have been taxed as ordinary income. What are your thoughts? Yes, good point, Cody. So when I mentioned part of the reason why I feel REITs are quote unquote good enough in a taxable brokerage account is because although the dividends they pay are otherwise regular ordinary income, you can deduct 20% of the dividends, and that gives yourself a little bit of tax favor. Now, Cody brought up a good point that I didn't mention. That 20% deduction under the Rule 199A, that's something that's specific to the Tax Cuts and Jobs Act, which is the tax changes that were put in place effective 2018. And those are what's going away at the end of 2025. And that's why I keep referring to in 2026 tax rates are going higher. They're going higher because the Tax Cuts and Jobs Act was only intended to be temporary. It's intended to go away at the end of 2025. Part of the Tax Cuts and Jobs Act is that 20% deduction on REIT dividends that Cody's pointing out. So yes, good point, Cody. Assuming that 20% REIT dividend deduction goes away when the Tax Cuts and Jobs Act eventually sunsets, whether it's 2026 or sooner, depending what happens in upcoming elections, I would suspect that 20% deduction goes away as well. If it doesn't and it stays, then yes, I still stand by my not so strong opinion that REITs are good enough in taxable brokerage accounts. But if that deduction goes away, then yeah, I'd say REITs aren't nearly as good in taxable brokerage and will be better off in Roth or tax-deferred. Thanks for pointing that out, Cody. Tommy. Oh, Tommy loves my t-shirts. Good. I have some really inappropriate ones that I haven't yet worn. I'm saving those for a special occasion. But thank you, Tommy. I'm glad you enjoy my shirts. Liliana, inside a Roth 401k, can you decide the pre-tax company contributions versus the Roth? If so, should it be invested differently? Different question. Do you recommend the Invest VT Sachs? Although, okay, good. Let me answer the second part of the question. I'm not venturing into any recommendations or discussion about any particular securities. Not because I think that's good or bad, just that's a line I don't want to cross. I am, professionally, I am a registered investment advisor. I'm regulated as such. If I give anything that even hints of specific investment or security advice, that's crossing a line I don't want to cross. Not in a public forum. I mean, for my clients, yes, we'll discuss any level of detail they want. That's my job. But for non-clients and especially public forums like this, no good can come of me giving my opinions about specific securities. So sorry, but I can't address the second part of your question, Ileana. First part though is very good. Inside a Roth 401k, can you decide the pre-tax versus the Roth contributions? If so, should it be invested differently? So the way Roth 401k works, or Roth 403b, or any Roth flavor of employer plan, the employee can decide where the employee's money goes. Assuming they allow a Roth option, yes, you can put your contributions, Liliana, in tax-deferred or Roth, or even after tax. We touched on that a few weeks ago. Let's leave that out of the equation for now. So you can make traditional or Roth at your discretion. If your company gives a match, you'll get the match. It doesn't matter if your money goes into the traditional tax-deferred or the Roth. You'll get the match just the same. But the match can only go into tax-deferred on your behalf. Even if 100% of your contribution is going into Roth, the match cannot go into Roth. The match will always be tax-deferred. Hopefully that answers your question. So yes, you can dictate where your contribution goes, but you have no control over where the match goes. That's always tax-deferred. So should you invest them differently? Yeah, based on, well, I don't want to say yes again because I don't want to be held to, Andy told me to do this on some Facebook forum. This is good guidance. It could be a good idea to consider investing them differently. Let me rephrase it that way. A Roth is a Roth is a Roth. It doesn't matter if it's in your 401 or if it's in a Roth IRA. If you're going to follow this across all your Roth style accounts. Now the difference is your 401k is going to have limited options. It probably only gives you a few dozen different mutual funds to choose from. But within that, I'm sure there's going to be all equity mutual funds, all fixed income mutual funds, a money market fund, which is basically just cash, and then probably some lifestyle or target date funds that are blends. So yeah, you can pick and choose and allocate your money in the Roth to one account, to one investment, and allocate your tax deferred money to something else. If your employer allows that. Now, I have to think about this. Your employer plan may only allow you to invest the same across all your accounts, but if they do allow you to invest differently across your Roth versus your traditional, then sure, you can definitely go ahead and follow this if you want to. Mavis, you can make a playlist on YouTube for your followers to easily get back to them. Yes, good advice, thank you. I do have a playlist actually for the 4 or 5 of these live sessions. I can just share that link because all of them get saved there. So yeah, you can see them all. Dan, I have a Ginnie Mae fund and a taxable brokerage account. Is this not ideal? I was trying to gain a bit more yield. This is my emergency account. Let me think about this. So Ginnie Mae stands for Government National Mortgage Association. It is an agency owned by the government. It is functionally and practically the government. It's backed by the full faith and credit of the government. And they issue bonds and other debt securities to help finance their operations, which is to facilitate and fund the mortgage market in the country. So interest on a Ginnie Mae, which is basically the same as the U.S. Treasury, should be taxable at the federal level, and it's in a taxable brokerage account. Is this not ideal? If this is your emergency fund, then it's not that bad, and here's why. Emergency fund implies this is money that you potentially need access to real quickly, right? And, let's say you're only 40 years old, Dan, I don't know, but point being, let's assume you're way under your 59 and a half, so you can't necessarily tap a Roth or a traditional IRA easily, or at least without penalty. So your emergency fund should be in a regular bank account or a regular brokerage account. So because of that, given the rest of the circumstances around what you're saying, no, I don't think that's bad, Dan, because I wouldn't advocate putting emergency money in a Roth or an IRA. You want it somewhere super easily accessible and without penalty, which is a bank or a brokerage account. Now, if you are over 59 and a half and you have no restrictions around taking money out of a Roth or IRA, then yeah, you can use them as your emergency accounts as long as you're able to tap that and get the withdrawals out in a timely fashion, right? Typically it's a few days to transfer money, although brokerages shouldn't be any different. But if you're already retired and past the 59 and a half and your accounts are qualified, whatever, there's not really anything wrong with using those IRAs or Roth IRAs for emergency funds. But people under 59 and a half, definitely emergency funds should be regular brokerage account or traditional bank product like a savings checking or CD. Okay, cool. Looks like that's it. So thank you all. Hope this one ended up being a little more awkward than I thought it would be. Part of me thought it'd be fairly straightforward, and as I got talking, I realized, wow, this is pretty gray, and it got a little more technical than I thought it would. I don't know if that's good or bad, but hopefully you all got something out of it. So thanks for joining. Great questions. I truly appreciate the comments and questions here. So thank you for everyone who's actually spending your Wednesdays with me. It looks like there's 41 of you watching and actually following along to the point that you're noticing what I'm wearing and posting comments and questions. So thank you for that. And with that, I will wrap this up, and we'll send around the link to this on YouTube, and hopefully see you again next week, same place, same time, where we will be discussing tax-efficient withdrawals. So that's once you get to retirement and you have your pot of tax-deferred, Roth, and taxable brokerage, maybe even HSA on top of that mix, what's sort of the ideal place to pull money from and when? Now that's going to be a little subjective as well. Again, it's driven by sort of basic logic and tax efficiency, but it's not going to be a black and white scientific discussion. It's kind of like today, there's different scenarios and things that come into play. But we'll save that for next week. So hopefully see you then. Thanks, and enjoy your week. Take care.